For central bankers, the word of 2022 was transitory, as in inflation would be transitory. Turns out not so much. So did our central bank wait too long to take aggressive action on rates? Tiff Macklem is governor of the Bank of Canada.
With hindsight, no, we didn't get everything right. We were surprised just how rapidly inflation went up. And, in that respect, yes, moving earlier might have been helpful. But I would stress that, even if we'd moved earlier, it would have been hard to move much earlier. The economy had a lot of excess supply. We were still dealing with multiple waves of the virus. Economy was closing, reopening. It was very hard to know how long that was going to last. And the reality is, when you reopen an economy, one of the things I think we really did learn is it's a lot easier to restore demand than supply. Monetary policy, fiscal policy did a really good job of restoring demand, but supply was really gummed up. Normally supply does a pretty good job it's pretty flexible. It responds to demand, but this time it couldn't, and that created a burst of inflation. And we could have done some things better, but I'm not sure there's much from a monetary policy perspective anyways that we could have done that would have avoided that problem.
In the same vein, when you look back at the path that you took, do you feel good about sort of the information you had and the pace you took?
I do think, there were good reasons to move up really rapidly. We were at emergency lows. It was clear that we needed to get rates up, and given we'd started so low, moving up in big steps, the market often calls jumbo steps, that was the right thing to do. From a risk management point of view, you did want to leave a bit of time to see how big is the impact of that. We've never done it this fast before. You don't really want to break something. So it did make sense to pause and assess whether we'd done enough, and we were very clear when we paused. That's what we were doing. We were going to take a pause, use that time to assess whether we'd done enough. As we got to the summer, it was becoming increasingly clear that we needed to do some more, and we increased a further 50 basis points over the summer. But I think this is an example of, there's risks on both sides, and you need to try to manage those, and that's really what that conditional pause was designed to do.
We do have, of course, people, human nature, they're looking ahead to the other side of this painful period. Everybody with mortgages resetting next year want to hear that rates are coming down. Other central bankers, in the US especially, are starting to talk that way. You're not saying that. You're saying at some point next year you see the potential for that. Can you put some color around what you think that means?
Well, look, rates will come down, and we're not ready. It's not the time to have that conversation. We need to see clearer evidence that we're headed back to 2% inflation. But when we have that clearer evidence, yes, we will be having that conversation, whether and when to reduce interest rates. But as you suggested, I think it is reasonable to expect that they'll come down, but they probably won't come down to pre-COVID levels. We had 10, 12 years of unusually low interest rates post-global financial crisis. I think there's good reasons to believe that we're not going back to those very low rates. So, that is going to be an adjustment. It's going to be an adjustment for households. It's going to be an adjustment for businesses. It's also going to be an adjustment for governments.
What's your expectation of when we start to see rates drop? You do have an outlook that I know much can change, but sometime in 24, late in 24, I think is what you're signaling.
Look, I think it is sometime in 2024, but I think it's, if you can tell me when we're going to see clear evidence that we're headed back to 2% inflation, when we're going to see, on core, and particularly we're very focused on core inflation. We need to see further and sustained downward momentum in core inflation. So it's not 1 or 2 months. We need to see a number of months with sustained downward momentum in core inflation. So if you can tell me exactly when that is, I can tell you when we'll be talking about dropping interest rates. But yes, I think you look at our projection, it's sometime next year, but I'm not going to put it on a calendar.
Are you worried about wages? We have seen a little bit of catch up maybe in some places, but wages locked in and multi-year contracts, pretty decent wage gains. Does that kind of create natural inflationary pressure in the years to come?
With respect to wages, I think the issue is not so much where they are. They've gone up as inflation has gone up. It's where they're going. And wages have been running 4 to 5%. And a good part of that is catch up. Going forward, though, inflation is coming down. We expect it's going to come down further. And 4 to 5% wage growth is not consistent with 2% inflation unless we see a big increase in productivity growth. And unfortunately, our productivity growth has actually been quite weak. It's actually been declining in the last several quarters. So, yes, what we're expecting to see, the labor market was very overheated. It is much better balanced now. And we are expecting to see some gradual moderation in wages. In fact, if you look at private sector wages, wage growth in the private sector is starting to moderate. Public sector has been catching up. So in aggregate, it's been fairly steady in the 4 to 5% range. But you're starting to see in the private sector that rebalancing the labor market is taking a bit of steam out of wage growth. That is something we will be watching closely. That is one of the indicators about where inflation is headed, and that's what we're focused on.
Still ahead, there's a case to be made that inflation could be higher than in the past. Should the bank let it be 3%? Stay with us.